Hey everybody, it's Faiz Versey and welcome. So I've got another very interesting video for you today. Again with the proviso that if you are interested in making money in real estate, you will find this very interesting. And for those of you who are not so interested in that topic, well, stick around as long as you can. And then if you have questions after that, I will be happy and delighted to speak to you about anything that you'd like to find out. So my friends, let's get into this analysis. What we're going to talk about today is should you invest in property in Ottawa? Very interesting question. So let's take a look at it. Now, if you're going to buy a house in Ottawa, excuse me, the first thing to understand is that investing in property is a long-term proposition. So I've got here right at the top where it says property maintenance costs over a 10-year period. So first of all, when you invest in property, don't think about flipping the property in a year or two because I have no clue. Nobody knows what's going to happen in the next year or two. But over a 10-year period, looking back at history, we have a pretty good idea that you will should come out ahead. And before I carry on, I should also introduce myself. My name is Faiz Versey. Did I already introduce myself? I can't remember. So let me do it again. I am Faiz Versey, real estate salesperson here in Ottawa. I work with LePage, and I would be delighted to help you with any questions, any advices you need around selling or buying property in Ottawa. Okay, so here we go. The first point was property is a long-term consideration. Now, when you buy a house, for example, there are certain costs that you have to keep in mind that are going to occur over this 10-year period. And I've called them here property maintenance costs, which you may incur over a 10-year period. For example, a furnace, possibly $6,000, aircon, possibly $4,000, lawn, property taxes, deck, roof shingles, carpeting, plumbing, appliances, miscellaneous. So all of these expenses are likely to come up over the 10-year period that we're going to hold this property. How will that impact us? And that's what we're going to discuss. So let's carry on. So what we're looking at is projections for Ottawa House. And what we're looking at here is we're saying that let's say you bought this house for $500,000. Year one, $500,000. Let's say there was a mortgage of $400,000. And therefore equity, your own cash of $100,000. So now what's going to happen? How are these numbers going to work out over the next 10 years? Let's take a look at that. So what we have here is we're looking about 10 years out when potentially you might think about selling this property. Let's see what can possibly happen at that point in time. So the price has likely grown to $814,447. How do I get this figure? I get this figure by looking at the property values over a 10, here it is, past AARR, which stands for the average annualized rate of return. So I've looked at the average annualized rate of return for the last 50 years in respect of residential housing in Ottawa. And it's averaged around a return of approximately 6.8% per annum. Now that doesn't happen every year. In some years it does go down, but Ottawa seems to be a pretty steady market. At some point I will take you through that particular chart, but let's just assume for now, for the purposes of this discussion, that the 6.8% per annum return is what we have seen has been achieved in the last 50 years. And I've assumed, just to be conservative, that for the purpose of this calculation, that the property values have grown at an average of 5% per annum over the next 10 years. So I'm actually just to be conservative to see what the numbers tell us. So at that rate of return, this $500,000 price today would have grown to $814,000. So if I wanted to sell it at that point in time, it's likely that I could command a price of $814,000 for that house. What else has happened? What else has happened during that period is that the mortgage balance, which initially was $400,000, has come down to $295,000. Again, excuse me. And how did that happen? Well, the mortgage has been paid off through the monthly installments. So I'm assuming in this case that the rental income from this property carries the mortgage payment. So this is amazing. You're getting somebody else to pay down your mortgage, which is probably one of the most important reasons for anyone to invest in property. You get somebody else to pay down your mortgage and eventually give you more equity in the house. Now, if you were living in the house yourself, again, every time you make a payment, some of that is going to pay down the mortgage, so you're actually building equity in that way. So this analysis also applies if you're thinking, should I buy a house? Should I not buy a house? This analysis will help you to understand that idea as well. Okay, so let's say I sold my house for $814,000. I had a mortgage balance of $295,000. And the equity, meaning the difference between those two numbers, the equity at this point in the calculation is $519,000, but not quite. Because over the last 10 years, as I explained to you, that we have incurred maintenance costs. These are going to come up. A house is a living animal. It has to be maintained. Do not go into deferred maintenance. Don't think that I'm just not going to do it. You will create more damage. A well-maintained house will maintain its value and give you positive results. So you have to budget for this. This is one of the biggest mistakes that homeowners make, is that they don't budget for the expenses that are going to come up. So these expenses are going to come up and you're going to have to pay for them from your pocket in this example. So the maintenance expenses were $100,000. That means if we take that off because you've spent that money, the equity in your pocket is now $419,000. And then the original equity was $100,000. So in other words, your net profit is $319,000. That is amazing. For a total return of $319,000, which translates into an average annualized rate of return of approximately 15% per annum. That, my friends, is amazing in what I would consider to be a relatively, I can't say guaranteed, but a relatively safe investment like housing. And in Ottawa, it's tended to be pretty safe. When we look back, as I mentioned, I've looked at the 50-year chart. However, it's also important for me to mention this disclaimer. These, you can read it, but it's very important to understand that these are projections. I have no guarantee that this is going to work out. And so you must always have a margin of error whenever you're trying to make projections and trying to see what might happen in the future. Okay, so that's why please read my disclaimer. Nothing is guaranteed. Anything can happen. Don't hold me to this 10 years from now and say, Faiz, you said this. I'm hoping it works out like this because it has happened to have worked out like this over the last many number of years. And given my knowledge of the past and given my knowledge of what's coming down the road in Ottawa in terms of job growth, population growth, infrastructure growth, this is a likely scenario. And look, this is how investors make money. They jump in. They know that there is a risk, but that risk is a calculable risk. So you're not taking an uncalculated risk. You're not buying the lottery and saying, okay, am I going to win the lottery tonight? That's a risk you cannot calculate. Well, if you really want to know, I think the lottery, the 649, I read somewhere, I'm not sure, but you have a 1 in 17 million chance of winning. This is a lot better than that. Okay, so you get what I'm saying. There is risk, but that's the risk that investors are willing to take, and usually they come out ahead. Can you lose money? Yes, you can lose money as well. So that's what you got to do, is you got to keep that margin in your mind, that if something goes wrong, then I should have a margin. So what can go wrong? For example, we're looking at a rental property. So for example, what if your tenant left and you were not able to find a tenant for approximately, let's say, 3 months? In today's market, as I speak now in November of 2019, the market is hot. If you have a rental property available for rent, it will go fast. Should go fast, depending on the location and if you've priced it right. But let's say we're in a market condition where rental properties are not going so fast. There's an oversupply. And in that case, do you have enough money in the till so that you can continue to make the mortgage payments for the, let's say, 3 months or 4 months that it may take you to install a new tenant? Those are the type of things that you have to keep in mind. As long as you can keep this project alive and well for 10 years, you should be in good shape. So, to answer the question, should you invest in Ottawa property? My answer is absolutely, given the provisos that you understand it's a long-term hold, that you're willing to make sure you keep the property maintained, that you have the wherewithal to withstand any negatives that happen along the way, and that you're generally going to be patient and intelligent about it. So there you go. And if you have any further questions, I would be delighted to help you. Any kind of advice. If you want to buy a property, maybe you want to sell a property and reinvest, both sides of that equation, I can help you with. Please feel free to give me a call or contact me in any other way. My contact information should be below this page and below this video, somewhere on this page. And so folks, before I go, one more thing is that please, if you like the video, please give it a like if there is such a button somewhere on this page. And don't forget to subscribe so that you can get informed about my further videos. And is there anything else I would like to say? I can't think of anything else. So until I see you again, take care. Bye-bye.